Welcome, everyone. Thanks for joining us today. We will talk today about one of the hottest topic in international trade. We had a very turbulent year over the last year with the pandemic, with the President Trump and outgoing President Trump, and especially for companies trading internationally, producing goods and services distributed throughout the entire world. This has been a very challenging episode. Now we are already in the middle of 2021, and we have a new president in the White House. But it seems not that things have calmed down. New challenges have arisen. European attempts to create a new relationship with China, for instance, through the investment agreement with China, have been stalled. The geopolitical environment for companies trading in the world has not improved. So the question really is, what does this all mean for international value chain? What will be the future of China, which is really center stage to this whole to global commerce will be for the future. This is what we want to discuss today. I'm very happy to have here really an all-star cast, an all-star panel to me to discuss this question. I have Eric Bergloff, who is chief economist of the Asian Infrastructure Development Bank. He has been at the G20 at high level panels. He is a non-resident fellow at the Brookings Institute, and he was also one of the founder or the inaugural director of the LSE Institute for Global Affairs. So really a distinguished fellow here with a lot of background to bring into the discussion. My second guest today is Kirsty Su, who is a researcher, or is a director actually of the Asian Study Center in Taiwan at the Huangsu. I hope I pronounced it correctly. A research center. She has a very distinguished career in economic policymaking, economic research, in particular with a focus on East Asian trade. So I'm very happy to have her here. And my third guest today is Alicia, a senior research fellow here with us in Bruegel, one of the most knowledgeable people about Europe, Asia economic relations. So I'm really happy to have her here. Of course, she's also the chief economist at Natixis for Asia Pacific. So I want to start this discussion today with each of you giving a short 5-minute introduction to the topic, sharing your views on what the future of value chains. And maybe let's start with you, Eric. The floor is yours.
Okay, thank you very much. And thank you for including me in this panel. So I thought what I would say is a little bit about how I see the global value chains as sort of coming out of COVID. I guess we're not coming out of COVID, but the experience of COVID for the global value chains and what we learn from that. So we actually set out to look exactly at the impact of COVID on global value chains, and then try to see what kind of change in behavior do we find in firms and so on. And I think the very first observation is that how remarkably resilient these global value chains were to this shock. Is the largest shock we've had in many decades, and it with the initial drop in output in China, of course having a lot of disruptive impact throughout the global system, but it came back extremely quickly, and particularly for Asia, I think that was very fortunate that it really came back so quickly. And when we look at, and here one has to be very careful because the data often lags, and it's not so easy to be very strong in interpretations yet, but our impression is that very little has changed, and we may be going to hear other points of view, but when you look at the aggregate, it seems like things have really come back to what they were before, and the trends, and we can come back to those trends that we observed before, they are still there. And you can ask, why is that? So, and I'm not ruling out that for individual companies and individual countries, there may have been some significant changes, but if you look at really the big picture, I would argue that very little has changed as a result of this tremendous shock to the system. And the first thing is to say that these value chains are really marvels of efficiency, ingenuity, and very importantly, they are embedded in relationships. So these are very relationship intensive arrangements, and they're not so easy to shift one to another, or to imagine having parallel or backup systems and so on. So that's the first thing. The second thing, which I think is very important, and there are many aspects of that, is that value chains are deeply embedded in many ways. So they are embedded in growth models of individual countries and of individual companies, and those strategies don't change overnight, and certainly growth strategies of countries take a lot of effort and sort of coordinated action to change. Of course, it doesn't mean that global value chains don't change. They change, reflecting technological change and so on. So they do adjust, but it seems like to this shock that we saw to the system, and of course the very understandable, there are many good reasons to draw from that the kind of conclusion that you want to diversify your suppliers, you want to maybe build in some redundancy into these relationships. But that's not what we see from the research that we have done. Of course, it doesn't mean going forward that we will not see change. I think there are a number of fundamental challenges that comes partly out of this embeddedness of global value chains. It comes out of some of these technological shifts that I mentioned. It comes out of the political economy. The pandemic revealed a lot of inequalities, and some of that has been tied to the global value chains, and there may be, particularly in individual countries, be a significant reactions to these arrangements. And of course, the big elephant in the room is geopolitics, and we will see how that will play out in the future. But from what we see, again, looking at the sort of aggregate numbers and the big picture, that doesn't seem to have happened other than in some very specialized technological sectors. Yeah. So maybe I'll start with those remarks and maybe come back to this question that came up about China's role and China's changing role. We can talk about that maybe later.
Thanks a lot, Eric, for this introduction. Christy, we just heard that basically from the data that we see so far, there has been little change from COVID-19. You're joining us today from Taipei, which is really very tightly integrated with China and is also really integrated into, for instance, semiconductors, so value chains that are seen very strategic, and we have seen secondary sanction impacting the relationship between Chinese manufacturers and Taiwanese manufacturers. So how is the view from Taiwan of this new role that geopolitics plays in value chains? I think you're still muted.
Okay, thank you very much for inviting me, and I'm happy to share with you Taiwan's experiences in developing and participating in the global value chain. So I'll first talk about the background to share with the audience the background of how Taiwan developed the global value chain in the first place, and then share with you Taiwan companies' response to the current GVC reshuffling challenges. And Taiwan is a very important player in several industry-specific value chain that includes textile, footwear, ICT and electronic products, and also semiconductor. Development of some of these value chains or value chain system can be traced back to 1980s when Taiwan began to relocate their facilitations from Taiwan to Southeast Asia. And at that time, Taiwanese company have adopted a common business strategy, which means when they go to invest in Southeast Asia, they will invite their upstream supplier and also their downstream clients to go with them. So this is the forming of the clustering of the supply chain in Southeast Asia. And later, when Taiwanese company began to invest in mainland China, they also adopted this clustering idea with them. So this helped the development of the complicated and comprehensive global value chain in China as we see today. So and this also indicates that, as Eric has already mentioned, that the global value chain system in China today are the outcomes of continuous investment jointly by Taiwan company, Chinese local company, and other business partners in that part of the world for 10 years or for 20 years. And therefore, it will be very difficult and takes many years to shift the global value chain completely from China. And this also explains that, for example, in recent years, India and Vietnam, take these two countries, for example, they have successfully attracted a lot of foreign investments in their countries to produce garments and electronic products such as smartphones, but they also need to import a lot of considerable intermediate goods from China, parts, components to support the assembly activities in these two countries. Now, about the challenges of the global, the GVC reshuffling or reorganization challenges, and how Taiwanese companies respond to this. First, the movement of GVC in the case of Taiwan is not a new thing. Actually, in early 2010, Taiwanese company already relocated their operations from China to Southeast Asian countries due to different reasons, including increasing wages in China, severe unfair competition from Chinese company, and most of all, risk diversification. So this has been going on for many years, at least for Taiwanese company. And in the last 3 years, when US-China conflicts have intensified, and Taiwanese company have adopted several different strategies. The first is decentralization and diversification. And companies with exclusive or main operation, manufacturing operations in China, decentralize from China and establish operations in other countries. For example, the facilities in China produce products for domestic consumption and for exportation to non-US market, while operations facilities in other countries, for example, Vietnam, Cambodia, will produce products aiming for US market. So this is decentralization and diversification. The second is regionalization and also localization. And this means Taiwan companies establishing different facilities in different parts of the world, the Greater China region, Asia, Americas, to handle each different regional market with localized supply chain. And however, in either of these cases, Taiwanese company will need to reorganize their supply chains according to availability of local support industry and also to meet their clients' requirements. I noticed that one of the issues that we should or we may look at is the decoupling issues. You mentioned about Taiwan's very tight relations with Chinese and also the current intense relations. Decoupling is indeed a challenge to certain sensitive, high-tech Taiwanese company, which have both China and US as their largest market. In the US Biden administration will strengthen its export control or other countermeasures against China. Taiwanese company will have to separate their production lines and R&D functions to handle China and US markets respectively. Or as what we see today, that TSMC, the semiconductor leader in Taiwan, and also Foxconn, they need to establish their operations directly in China. So these decoupling issues will be a challenge to Taiwan, but whether it will continue to stimulate more operations or more relocation, we still need to see. So I'll stop here.
Thank you very much. That's very interesting. Before we go to Alicia, just a short reminder, we have a Slido as always, where you can ask questions that we will later address to the panel in the Q&A. This time it is China, so you have to go to slide.do and then the hashtag China to ask a question to our panel. Maybe now let's go to Alicia. Tell us, what is your perspective or your view on the challenges and the future of value chains in East Asia?
Thank you, Nicholas. Well, first of all, it's great to have Eric and Christy with us. It's really our great pleasure to have you talk to our European and actually global listeners on a topic of such relevance for Europe, because so far we've basically talked about resilience of value chains and of course China, but the reality of matters is that the largest value chain in the world continues to be in Europe. I have to, at least according to input-output data. Now, what is true though is that our integration to the global value chain, by our, I mean Europe, is shrinking. By the way, the whole integration, global integration in value chain is shrinking. But as Eric said, in a very resilient way, meaning it's not about COVID, it's not even about the trade war. This has been a process that has been going on since 2008. And the main reason, perhaps is even positive, is the fact that there's more value added, more vertical integration in major economies, China being a very good example. Then there's also the shortening of global value chains. So Europe is an example. So there's a lot of things that are positive in a way, if I may say so, about this idea that looks so scary that value chains are shrinking. Well, maybe they're shrinking for good reasons. I wanted to start with that. For Europe, that shrinking size, which is much faster than that of China, is slightly more worrisome. And we wrote a blog about this at Bruegel, because the main reason for China for that small reduction in its integration to the value chain, it's its own increase in value added. That's China. But for Europe, it's slightly different. It's it's called DBX. It's basically the value of exports used for, as intermediate goods for other countries to re-export, that is shrinking. So in other words, Europe is being substituted as a major exporter, to make it simple, of intermediate goods. And it is importing many more intermediate goods into Europe produced elsewhere, mainly China. So that's why our value chain is shrinking. So it's a slightly less positive view. We looked into the factors why this was the case, and this is pre-COVID. It has nothing to do with COVID. I mean, it's hard to, we didn't do a big empirical analysis, but it seemed as if basically we lost it in ICT. So we look at sectoral competitiveness, and we clearly lost it in ICT. We may lose it again with new sectors, by the way. So this is a big topic. Semiconductors, we can talk about that later. Maybe not new, but I mean for Europe new in a way, because we're so far behind. And textiles, but this is an old story. You can think of the Portugals of the world and so on. So these are the two main sectors where Europe really, quote unquote, lost it in terms of competitiveness, sectoral competitiveness and its value chain. So that's one thing I wanted to say, that a lot happened before COVID or even the trade war. And not everything was negative. So for some, it was more positive than others. Now, what we see I think in the trade war is more of a sectoral characterization of this reshuffling. So maybe nothing happening somewhere and a lot happening elsewhere, or, of course, related to sanctions and the idea of bifurcation, especially on the tech space and so on. So that's one thing that I think is not necessarily COVID, but trade war related, maybe tech war related. And then COVID. And I think COVID is very ironic, because while everybody was talking about, even myself, about China's central role in the value chain and whether that would change because of the trade war, whether China would lose part of that role and the reshuffling that Christy was talking about, when you look at gross data, this is all we have, gross trade, because we don't have yet new GBC data, I mean, new input-output data. We hope we do very soon, but not yet. When we look at gross data, it's just mind-boggling. China is actually increasing even beyond what was the case before to a scary level. I mean, not scary, but kind of wow. It's the estimates I have for 2020 are slightly above 14% of global market share in exports. So it came down from slightly below 14 to 12, and is going back in 2020. So, and we did a little bit of analysis per, basically bilateral trade relations, and one of the regions that loses out the most is still, it looks taboo for it. It seems taboo for economists to talk about bilateral trade because we can be called Trumpists or you name it. But I have to say this: in the case of Europe and Latin America, that's where you see the biggest difference between exports and imports between China and us, or Latin America even worse. But that there is a lot of value of commodities, and I guess it must be improving right away in 2021. So, is this because of lack of competitiveness in Europe? What's the reason for this pattern, and what is the reason for China to have increased global market share so fast in 2020? Is this does this go counter the idea of that reshuffling? These are questions I have really more than answers, but I think they are important because I really don't know how to read this. Is it a competitiveness issue? Is it a supply issue from the rest of the world? Is it going to change in 2021? We're not seeing much of a change, by the way. We just got trade data, I think, yesterday for China, and it's still booming. So I just conclude by saying that it is such a tough issue because I kind of had a story before even the trade war, that kind of structural reduction of the size of value chains or the integration, especially in Europe. And then I had a story for the trade war, which was the coupling, the bifurcation, everything we just talked about. But suddenly COVID looks so different because in a way, China is increasing market share again all over the place. So where are we? I think that's what I wanted to bring to the table, that COVID might actually be the opposite of what I thought it would be, because I thought it would be more of an acceleration of the trend in the trade war, but we don't see that in the data yet. Will we see it? I don't know. That's all. Thank you.
Thanks, Alicia. I think you really kind of framed very nicely, I think, the biggest question that we have. I think we all struggle with understanding this data and what this means. And let's see if we can make more headway on this in this panel, or maybe a little bit. Let me go back to you, Eric. So we heard now from Christy and Alicia that already companies are diversifying their supply chains. You told us in the beginning that COVID-19 had, and this is also what Alicia just told us, had not maybe the effect that we might have expected. It had a very little effect. It was a non-event in some way, in the sense that it didn't lead to more deglobalization, rather maybe in the opposite direction. But we see a lot of political moves here in Europe and US. We have talked about relocation, reshoring, industrial policy that's supposed to make us more resilient. In China, we have the dual circulation plans and the industrial policy. So where do you see the longer run trends and actually, is it possible for politics to be so destructive to disentangle this, or is actually the currents of economics stronger than the day-to-day politics? What's your view on these questions? You're muted, Eric.
So maybe I can. So let me say a few words more about what happened in China to sort of fill in the picture that Christy and Alicia were giving. So indeed, what happened, and I think that's, if you look over the last 10 years, the most dramatic change is the move of China into intermediates. And that has happened basically at the expense of almost every other part of the world. And Alicia have shown this in a number of interesting papers and articles. But so we have looked a bit more closely at this, and what you see is that China has really managed to move up the value-added ladder, and it has actually also managed to move out some of the activities that Christy were talking about. I think actually reflect some high labor content activities that China has managed to shift to, both to the other field or further away from China. So the net effect of this is that the productivity has really increased increased quite dramatically in these value chains. There are other things going on in China that has maybe had a different impact, and actually the net result may be indeed some falling in productivity. But what also happened, and which is, I think, perhaps even more surprising and more more interesting, is that we know that there has been a shift from north to south in terms of economic weight in China. But it would really stands out when you look at the sort of GVC data and the export data, is that the West, and particularly Sichuan with Chengdu and Chongqing, have really emerged as major export hubs, and some of that is actually to Europe, and some is via the new rail link, and also on quite very significant Japanese and Korean exports now go via China by rail and to some extent by road. So that, if you look at pictures on the export of different parts of China, it's quite striking how, if you go back 20 years or 10 years, you see a remarkable growth in the west of China, particularly Sichuan, but also Kunming and so on. So that has really changed how China works, and what I think, and what Alicia finds in sort of when she poses this puzzle, I think is not so surprising when you think about it. What happened was that China, yes, had a very serious shock, but it recovered very quickly. You know, we can discuss what was behind that resilience. The rest of the world has not recovered as quickly. It might recover, as we get vaccinations going and so on, but that did not happen. So China has actually, there's been an opportunity for China to increase its export. It has reinforced those trends that were already there in terms of moving up the value chain and the increased productivity in this part of the Chinese economy. So that to me is, there's actually not so much of a puzzle for me. It's actually much more that what I mentioned in the beginning, that these are very resilient arrangements, with incredible pressures on efficiency, and very embedded in relationships. And I thought what Christy described, which I very much recognize, this kind of moving with the suppliers and clients often, and we saw that, by the way, also with Japanese manufacturing chains earlier in Asian economic development. But that kind of high relationship content is very important when you look at global value chains, I think.
Thanks. Maybe let's stay for a moment also on this COVID story. Maybe not in the sense of the shock that happened last year, but also about the differential in growth rates you might see over the next year or two. So we had very different strategies between Europe, for instance, which did, and East Asia, when East Asia really managed really well to contain the pandemic. Especially China didn't really have much higher economic growth last year, but maybe also this year. We see now a divergence between the US and Europe. Christy, so maybe my question for you is, to which extent do you think this will affect businesses in Asia, their decisions to where to locate and how to manage their customer and their relations? Maybe let's here also to take in an audience question. So Giuseppe Porcaro, he asked this question about whether kind of we will see a separation of companies, that basically some companies decide to serve some markets and other companies do serve other markets, and how is this decision affected by the divergence in growth rates and economic policy that we might see in the next years?
Okay, Nicholas, thank you very much for the question. I think, yes, we here in East Asia are very lucky because several countries, many, have successfully contained the pandemic. Therefore, at least for Taiwan, Vietnam, China, I mean, the GDP growth last year was positive, and the manufacturing activities and local consumption continue to grow. So we think in Taiwan that in the post-pandemic time, China will still be the largest, I mean, if not the largest, or at least the second largest market for most of the companies here. So they will work very hard to maintain the Chinese market while try to explore the non-Chinese market. This includes the American market. Taiwanese companies are now keen in exploring the Latin American markets and also African companies. And also we see the changing nature of Chinese market to at least Taiwanese company. Now Taiwan company investing in China mostly for services, mostly for the services market, and also for the new economy, including the new energy, the green thing, the IoT, and also the smart, for example, the smart healthcare. So, but we don't see that much focus on the labor-intensive manufacturing activities in China anymore. So we think that Taiwanese company, at least they separate their investment strategy. For China, it's for domestic market, services market, and new economy market. But the export-oriented manufacturing activities will be located in countries outside China. So this is the main trend. And for the question from the audience about the separation of the companies, I think this is one of the very important strategies adopted by high-tech companies here in Taiwan. So most of the high-tech companies, they have formed a group of companies, okay? A group of companies, either to take part in different parts of the supply chain, and now they not invest directly in the manufacturing activities. They also, for example, the Foxconn, they merge a lot of companies so that they can expand from manufacturing to services to channel to distribution, also to services. So these companies tend to have different companies under their structure, so they can handle different markets, different products. And as for China versus a US company, the practice is they will separate different companies. Company A to take care of the US market, and company B to take care of the Chinese market, so that they have separate personnel, separate scientists, and also separate R&D function. And this practice so far works well. But we don't know what will happen in the future. But this practice so far works well for both Chinese clients as well as the US clients. Thank you.
Thanks. Maybe let's just go further to Alicia now in this particular issue. So what are the costs of this? So basically now we see that companies, as Kirsty tells us, are separating their businesses. They're separating their, and this of course means that there will be doubling this, that you will have the same activity maybe on two sides. It also means that companies have to decide sometimes on issues, for instance, on IP. So what the US is doing in semiconductors is basically telling you if you use AIS IP, you cannot sell to particular Chinese companies. So what are the economic costs of this kind of separation?
Well, first of all, I think this is basically the title I chose for this session, from tight coupling to loose coupling, which is an engineering concept, but which is actually used for value chains. And the idea is that from efficiency, meaning reducing costs and having one single line of production for every single input, you move to basically network production, by which you may have one network and a parallel network, not only because of sanction-related issues, entity list, or you name it, but also because of resilience, because you want to have a spare wheel. And I think this is becoming very important for companies. I think COVID has shown, a harsh phase of excessive efficiency reasoning behind the tight coupling idea, versus having perhaps more costly, which is your question, but more stable or more resilient value chains. So this is, for the consumers to decide, whether they prefer to have a stable stream of consumer goods eventually, or intermediate goods for the companies, but at a higher cost. And is this a one-off? And then maybe we shouldn't worry about inflation related to supply chain reshuffling, or is it more than a one-off? Then we should worry about inflation. So I think there's a lot of other topics related to this. But if you allow me, Nicholas, I want to clarify to Eric what I meant to say that is surprising. I understand that China was able to produce before anybody else. First of all, COVID hit China earlier. Second, China managed to contain COVID together with other Asian countries, of course, but it was very, very impressive what China did. But what I meant to say is that if you think about China's economy recovering, literally second part of the second quarter of 2020 all the way to today, while the rest of the world was in big recession, you would not expect China to run such a huge trade surplus, because basically it should be China importing more than exporting, given that demand was there while it wasn't anywhere else in the world. That's what I find puzzling. But I think that puzzle, you said it very rightly, is explained from the supply side. Maybe we're unable to export, we were unable to produce because our factories might have been closed or half closed or at a lower capacity of production. So that's that in a way solves the puzzle. But still, for an economy growing 18% like the first quarter, China's growth rate over 8%, it's still somehow surprising that imports are not increasing faster. So, and I think the reason is that China's vertical integration is so much bigger than it was, and it has happened so fast that we can't believe it, but it is really there. And this brings me to the fact that maybe this meager, it has improved, I have to say, but overall, given the growth rate, meager import growth in China might be structural, because again, it's just a reflection of the much more integrated production. And if this is the case, in a way, we're already in dual circulation. We don't need to wait for it. For whatever it's worth, it might be good or bad for the world, I have no idea. But the point is that I think we need to think about this issue, because for such growth levels, China's imports in 2020 were low for what one would have expected. And I don't think it's enough to think that our factories were closed, because some weren't, it's a very general thing. The only country in the world that really managed to export more than in 2019 was the US. But we all know why. This is phase one deal, import. So it is a little bit of a thing for, big exporters like European companies, like South Korean companies, like Japanese companies to think about. This goes beyond value chains. But I just wanted to explain what I really meant about the battle there.
Maybe let's continue on this thread. I think there is also an interesting question here about the role that other parts of the economy, in particular functional services, but also services in general, play for value chains. What we've seen over the last decades is that the share of services embedded in manufacturing has grown considerably. But if you look at the integration of China in services, it's very different than global integration in manufacturing. To which extent is this kind of divergence that we see in imports and exports in China also a story about structural change and change in China? Maybe let's go to you, Eric, on this.
I'm not sure. So just a few observations, and I haven't processed them yet. But so we did look at what happens in individual sectors, and you know, it was very striking that in many sectors that we would think would be sort of where there this kind of dual circulation argument would hold, and where you really want to protect yourself. On the contrary, we saw that China actually invited or tried to engage more, because as you would expect, if you were not constrained, you would like to, in certain sectors, be part of, you know, learning. You want to be at the front. You want to be exposed to competition, and I think that is, in many sectors, that's what China is going through, and that, I think, is one important explanation for why China has been able to improve its productivity in many of these high-tech sectors. And I think a lot of the so I don't have a good answer to the puzzle around the imports. I mean, there is some problem with you know, subdued consumption in China, which is a little bit a hangover from COVID, that there were a lot of balances in households and some companies and so on suffered because of the shock of COVID, and some of this could be explained by that, and that, you know, it's taken time to build up savings again. We know that, you know, a lot of households are very dependent on individual savings because, you know, the lack of a social safety net and the lack of health insurance and so on. So that would be my interpretation for why we see somewhat slower consumption, and that would also then feed back into imports. But you know, I'm not ruling out that there could be other things going. I would hesitate, though, to point to the structural changes after 1 year. That to me, there could have been something that's gone on for a longer period of time, but I wouldn't say that this is something that was triggered by COVID. Just a comment, since we were talking about other parts of the world and you know, other parts of Asia, that you know, a lot has happened also to value chains in other parts of Asia. So you know, Bangladesh, for example, has really come up when it comes to textiles, and you know, India has actually lost quite a bit. The patterns in India are also much more focused on a few big cities, not this broad engagement of the industry across more or less all of China, or the sort of industrialized parts of China. So I think there are some important differences in how different countries have used global value chains to develop their own economies.
Thank you. Maybe let's take up another question from the audience. I have a question from Jana Dreyer, and she asks about the question of technology. So which role will automation, or has automation played in the whole question of supply chain reshuffling? And I think here we can also think about the question also of labor costs, which I think are closely related to this. So we have a change, and China as it gets richer, of course, its role in the global value chain will change. How will this kind of interaction between labor and automation shape the future economy? Maybe, Kirsty, that's something you might want to just respond to. You're muted.
Okay. Thank you very much for the question. I'll try to respond part of it. For Taiwan's case, at least 10 years ago, Taiwanese company, labor cost was the most important factor when companies decide where they are going to set up their investment. And therefore, companies, I mentioned that in 10 years ago, they relocate from China to Vietnam, to Cambodia, due to Vietnam and Cambodia, they have lower labor costs compared with China. So this is the labor cost they consider as the most important for their decision making. However, in the past 10 years, this kind of labor cost and also tariff are less and less important in affecting this decision, investment decision, because the supply chain, whether this country have, or these places you are going to invest have sufficient supply chain, have sufficient support industry is actually one of the major factors. For example, Taiwanese company setting up their garment factories in Vietnam. They have to import like 40 to 45% intermediate goods from China. And therefore, I think in April last year, when during the pandemic and Vietnam has to close the border with China, and this Taiwanese company manufacturing garments in Vietnam, they have nothing for their assembly activity. So this means that internal support industry is one of the very important thing for them. And in recent years, I think Eric mentioned about the geopolitical things, and this is right now the most important lessons for our business. For example, companies invest in Myanmar or Burma, facing problems of this human rights issue, and also companies using cotton from Xinjiang, China, actually are facing possible sanctions either by their consumers or by the government. So right now they have to take into consideration various factors that are not important to them 10 years ago. So this is something very, very new and something more urgent for business community, at least in export-oriented industry.
Maybe Alicia, do you want to respond to this whole topic of structural challenges in response to technology, or also just the structural change in China?
Yeah, I think there's two forces regarding the impact of technology on the size. And by size, I still mean integration, each country's integration in the global value chain. I think robotics and robotization of manufacturing will probably allow countries, say China is a good example, but one can think of Japan or South Korea, frankly, maybe even Taiwan, to not to need to replicate Japan in the 80s, meaning the flying geese, or at least not to need to do it as much as before. And that should reduce in principle, the size of supply chains globally. But there are other factors, like technology. You can think of digitalization of services. You can think of blockchain technology. I think all of that is pro-globalization, if you think about it, because there will be many more forces to make services more more tradable than they used to be. And Nicholas has worked a lot on this topic, so he knows much more than me. So I guess it depends on which force is more important to answer that question. But I think there are different types of technological changes affecting value chains in different directions.
So for the last part of this discussion, I would like to talk a little bit about politics and policy in particular, more policy than politics maybe. So this whole question, we have got a lot of questions from the audience, from Kim and also Jose, about for instance the Green New Deal, green policies. We got a question about the level playing field. Alicia, you published just yesterday a blog arguing that the European policy towards China is a failure, or has failed to reach its objectives. And maybe can you set a little bit the stage or discuss what your views are on basically the political or the policies that we could use, or what should be done to address these problems in the value chain?
Well, I'm not aware I said that, but I guess that's how it reads. So I need to read that blog again. No. And maybe because I got comments like, oh, that's a bold statement. And I was like, I wasn't aware of such a bold statement. But anyway, I guess this is the reality of geopolitics and geoeconomics, that sometimes you're not even thinking geoeconomics, but it sounds as if it is, you know, and that's why we need to be careful. But the point I wanted to make is very simple. It's really, this was a comment on the Commission decision to basically carry out something we knew already since the white paper back last May, I believe, on measures to limit subsidies from foreign companies operating in the single market. That was the idea. And of course, there's also the other measures on more related to this seminar on value chains, how to improve the resilience of Europe's supply chains, etc. But the block was mainly on the first set of measures, and the whole idea was really to say that it would not work in as far as you can say stop a few of the subsidies, but the whole point is how those companies could, I'm not saying they always do, but could compete in the European market without a level playing field, simply because of the lack of level playing field in China. So to make it very simple, if you operate in an oligopoly in China and you have extract rents and then you transfer part of those rents to grow in Europe, for many this is a great idea because European consumers can benefit. But the point I make in that blog is that for certain sectors, especially new sectors, there may be economies of scale, network externalities, you name it, that are such that if you arrive first or if you can compete price-wise, you can capture the market. So the whole point really for us is not to chase our single market, or at least not only, but to make sure that China fully opens its domestic market, not only to foreign competition, by the way, but even for domestic players, meaning private players. That was all. So, you know, it's something, by the way, that I don't think is a failure because we cannot do it because it's not our market. So, you know, I don't think we Europeans can actually achieve that. And I think the best thing we can do is to convince Chinese policymakers that it is in their own interest to do that. And that's all. So that was the idea.
Thanks. Sorry, failure was my word. Of course, your blog is much more nuanced than that. Maybe let's go to Christy. So in Europe, there is, like, as we just heard from Alicia, and what she wrote about in her blog was this kind of idea that we need to really make sure that that's the idea of the policy, to make sure that, for instance, with subsidized investments in Europe, European companies don't lose out against state-owned enterprises or subsidized activity from China. But also we have European policies on the Green New Deal, carbon border adjustment tax, which is also kind of aimed at foreign competition that might have lower prices for the green policies. And I wonder, what is in Taiwan the view? What is, first of all, the view of Europeans' efforts on the carbon border adjustment mechanism, but also what is Taiwan's own policy to make sure that the Chinese state-owned enterprises don't take advantage of open markets in Taiwan?
Yes, thank you very much for the question. I think some of the audience may know that 10 years ago, there was a framework agreement between China and Taiwan, and that we call it ECFA, Economic Cooperation Framework Agreement. And that agreement provides Taiwanese products several hundred tariff-free market access to China. So that agreement helped these several hundred products to have better access. However, apart from that, except for that, Taiwanese company face with other companies from any part of the world, the unfair competition in China. So this is something that continues to exist, and therefore Taiwanese company have to, for example, develop their own strategy to try to at least get a better treatment with their competitors. So that goes with the Chinese market. And as for the European the green strategy, my research team, I mean, this is the second year my research team is conducting the EU's new strategy, including the Green Deal and also the digital deal. So 2 weeks ago, we actually have a webinar with the EU commissioners, commission people to explain to us your carbon adjustment mechanism. So that is something very important for our government and industry. And I believe most of the large companies, especially those export-oriented companies, steel, electronic products, semiconductor, they are before our government finalize its policy. These large companies have internally discuss how they are going to respond to this new change. So we pay a lot of attention to what is happening in EU because that is one of the most potential market to Taiwan company after China and the US company. Thank you.
Maybe let's go to you, Eric. What is your perspective from also as an economist at the Development Bank, but also just as a person very knowledgeable on the Asian economies? What's your perspective on the role that Europe plays in Europe policies, how they're perceived in Asia, and do you think they're actually good tools, or how do you think we should retool our policy?
Yeah, no, I think there's no question that Europe has lost out to China and maybe even to some other countries in Asia in terms of these global value chains that we have been discussing. And you know, there are a number of issues there that have to do with the developments within Europe. That, for example, that these value chains that were built between Eastern Europe and or Central Europe and Western Europe, Germany particularly played a very important role. I think they have lost out, and we have to look at, you know, what is the reason for that. And you know, I'm not ruling out that there are those kind of issues around subsidies and so on, but I think that is not the main explanation. I think there's no question that the Chinese companies have become more competitive, also based on improved productivity and you know, massive ability to push down costs because of scale. I mean, you can say that can also, of course, be perceived as unfair in some sense, but I would look more at, you know, what can Europe do to improve in terms of providing the right conditions for restoring value chains and Europe not losing out in these critical industries that Alicia has referred to, you know, that where China is so successful, all the digital industries and so on. And you know, my sense is that China is going to become increasingly competitive also in services, and you know, the whole financial services sector here is you know, in many aspects have been quite old-fashioned, but if you look at what's happened now in sort of consumer finance and online sales and so on, I mean, that model is going to go at least to the emerging and developing world and be very powerful because it's achieved financial development that we haven't seen. You know, so yes, there are definitely some structural issues around state-owned enterprises. There are issues around possibly around subsidies and so on, but I think we are, if we think that's the main reason for why Europe has lost out, I think we are not understanding what's going on.
Thank you. Let's close the discussion with maybe a small round of closing remarks. If all of you could, yeah, maybe let's start with you, Alicia.
Yeah, I want to comment on this idea that Europe lost it because of lack of competitiveness. I think these are two different topics. I think Europe became less competitive. Well, first of all, Europe still is the largest exporter in the world. So, you know, maybe we're not very competitive. Thank God we're not more competitive, because if we were, maybe, you know, we would have even bigger problems with the US than China does. But I do think we lost. I mean, just look at R&D. Yeah, we basically are at par on average with China, but many European countries are well below China in terms of R&D to GDP, and you know we can think about education. So we probably lost part of our competitiveness, but I'm convinced that some sectors with both with big network externalities, but also with capture markets, China would not be there without subsidies. I'm absolutely convinced of this. So there's two things here that we need to take into account, and I've seen it with my own eyes in some major infrastructure projects, and the type of funding that countries have received, which have made them opt for Chinese projects rather than Japanese, not even Europeans, but Japanese or South Korean. So I think it's a mixture of the two. And by the way, this is not only China, because many countries use subsidies to, you know, for project finance. So it's not really a new story. It's just China's size is a new story. And that makes it more impactful globally. But that is all. So these, I guess, are two aspects of a reality that we all need to take into account. But for Europeans, we should focus on, of course, becoming even more competitive. That's for sure.
Thank you. Christy?
Yes, I have 2 points to make. The first is the reshuffling or reorganization of the global value chain will continue in the post-pandemic, and Taiwanese company will continue to diversify and relocate their operations in parts outside China. And that, together with Japanese company and Korean company, will provide a lot of opportunities for newcomers. So the policymakers need to pay attention to this and make sure that there is smooth transformation of the GVCs, and make sure that developing countries will benefit as much as developed countries in this organization of the GVC. The second point is, I think I should mention that in the past 2 years, Taiwan and the EU have stronger collaboration in terms of trade, in terms of mutual investment. Last year, we invest in EU $2 billion US. That is the peak in the past 10 years. And also we see increasing European companies coming to Taiwan, to invest. And for example, the semiconductor value chain, and EU are very interested in working with Taiwan. So when TSMC in Taiwan, when they invest in Tainan, we see increasing investment by European companies to support TSMC new operations. So I think this is already a sign of emerging GVC collaboration. I believe in the future that kind of collaboration will continue and intense. Thank you.
Thanks, Christy. Eric, your final remark?
Yeah. So I guess my final word would be that these value chains will change very slowly, and you know, that these, because they are relationship intensive, because they are grounded in country growth strategies, individual company strategies. I think one thing that we haven't spoken about, which I think will change things, but also put pressures on global value chains to become more efficient, is the whole climate dimension. So, you know, what I think, and that goes to what Christy was talking about, we're going to see massive changes in developed countries. China is going to go through massive changes in terms of its net zero carbon trajectory. What worries me most is that large parts of the world will not be part of this journey, or we have to do a lot to make sure that these value chains are inclusive, and that they, when we are imposing or climatic and environmentally related conditions, which we have to do, that we also support countries to allow them to participate. Because if we start locking out countries, there's already a lot of discrimination against emerging and developing countries in terms of environmental and social governance standards and so on. We have to be very careful to make sure that we can bring these countries along. That to me is the greatest worry.
Thanks, Eric. Thank you all. I'm afraid this is all we have time for. There's still a lot of questions remained, and this is a fast-moving subject, but I'm sure we're going to have many more opportunities to discuss this. Thank you to all three panelists for this discussion today. For all of you in the audience who would like to follow more research on these topics, on our webpage, bruegel.org, you can find research by Alicia and me, but also from external publishers and all our colleagues. We have now a new newsletter on China and China-Europe relations, Songhu Mundus it's called, where you also get in your inbox news research. We have upcoming events next week, next Wednesday, about the COVID recovery. And also we have now many weekly Clubhouse talks, for instance, today with Natalie Tocci on the geoeconomics of the or geostrategic autonomy, what it's called in Europe. Thank you very much for joining us today, and have a nice afternoon or evening, depending where you are.
Thank you. Thank you very much, Niklas.
Thank you so much, Eric and Christy and Niklas. Bye.
Thank you. Bye-bye.
Ciao.
Thank you.